Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
In the background, because I've literally just got back from London. So Carmen, very gratefully, I think she's going to be doing some of the heavy lifting today. I am here and I'm here to support, and sorry, Carmen, I didn't get around to changing the date. We've had a day, let's just put it that way, and it's only 9 o'clock in the morning. But it's always good to be back. And today's session, we are, kind of like we do tax faculty sometimes, Carmen, where I take the majority share of it, and then you help out in it. So we're going to do a little bit differently this time with SAAA. I'm still here to look at the ethics and the accounting and the auditing, but it is quite a heavy hitter with the tax side of it as well, which sometimes, the accountants need to know about. But at the end of the day, the heart of this is dealing with disputes, dealing with errors. I've thrown in estimates a little bit as well. And just when you didn't get things right the first time, it's kind of the theme that I was taking when I was looking at how we could make this an SAAA topic.
Yeah. And I think, Karen, something just to add to that is part of the reason why, or one of the other reasons why we looked at the split is because accounting, well, the IFRS standard is a little bit more forgiving on the errors side, shall we put it that way? It still doesn't approve of them, and there's lots of tut-tutting and, frowning, but it's nowhere near as harsh in terms of consequences and the impact than getting it wrong when declaring to SARS is. So that's also why we thought it would be quite a nice approach to go and say, well, here's what IFRS tells you to do. But you need to remember that actually that's only one of your obligations. Your other obligation has some quite nasty consequences.
Yeah, we've come across this a couple of times where I keep on forgetting that, oh, wait, hang on a sec, SARS wouldn't let you get away with that. And in accounting, I wouldn't say we deal with it casually, but we deal with it casually. We sort of said, okay, well, as long as we're transparent, sort it out and move on. And we don't always think about the tax consequences of it because we do have this pretty forward-looking approach in many respects. So I do think, and that's why I thought I jumped in first, because what I talk about is quite familiar. There are a couple of things I want to raise in ethics with it, because I think there is something we need to talk about in terms of professional courtesy and in terms of how we manage situations. Because I do sometimes worry that maybe we don't always manage situations like we should. So I was, it looks little when you look at the slides and you think, oh, well, Karen's only put 2 slides in, but each bullet point has a lot to talk about. So it's a case of, knowing that people have an idea of what we're talking about, but just fleshing it out a little bit. Please ask questions. Please put your thoughts into the comment box. Because this is what Tech Talk is supposed to be. Tech Talk is not supposed to be us sort of reiterating the theory of it, as much as us having a conversation about the practicalities of it. And just to remind you of what the theory is, if nothing else. Who we are, I think by this stage most people are familiar with us, but if you're not and you want to go cyber stalk us and find out a bit more about us, our bios are here, and you can always look us up on our websites and find out who we are. So to get into it a little bit, okay, as I said, this is Carmen's heavy hitting because it's something that as accountants, I think we just need to stop and prepare ourselves for the tax issues, because we don't see it quite in the same way. So when I look at errors in ethics, to me, I think is not an area we discuss often enough. So the first question I was asking is, committed by who? Because it's not always the client that makes the error. It's not always their team or their system that does the error. Sometimes it's us. Sometimes it could be that I'm drafting the financials and maybe the tax partner has done a miscalculation in the tax calculation, which I then pick up while I'm doing the tax note. Or maybe, when I'm reconciling the employee records, the payroll, I suddenly realize that, they've they've claimed TERS as their thing rather than what it is, or the PAYE doesn't reconcile, or something's happened, and maybe it's a colleague's work where the errors come through. Maybe I did the error last year and didn't realize it. Maybe who audited the financials last year? Did they see it? Did they decide to ignore it? Did the client misrepresent? What were the implications? And there are implications when it comes to ethics around who and what our response needs to be. And I mean, just off the top of my head, if I look at this, I think, well, firstly, did we take due care? Because due care is always going to be the number one disciplinary action against us when there are mistakes. I mean, our membership bodies and our regulators can come at us for failure to take due care, and they come at us for spelling errors and for sort of saying that you used IFRS instead of IFRS for SMEs. And meantime, you've done IFRS for SMEs, but you just forgot those last 2 for SMEs in your report. So the smallest errors, the financial statements and our reports are the ultimate product that we give at the end of the day. So Carmen, you and I, when we've seen financials, we've seen some real doozies of just really obvious disclosure errors. Not sort of claiming things that aren't disclosed or the other way around, but then also in the numbers. How often do we get this conversation of, whoops, okay, we didn't see that last year, or we didn't think it was such a big deal last year, but it actually is. And so there's one side of it, okay, to me as an accountant, not tax, accounting, the best case scenario is we're tootling along and we come across something, and maybe it wasn't such a big deal last year and it was under materiality or something like that. And this year now it's snowballed into a bigger number. And we go, you know what, we actually have to correct this right back to the beginning because this is actually an error. There's a systematic error here that needs to be corrected. And errors, as we'll talk about in the next slide, we go back to the beginning. We go back to when it started, but we don't have to recall necessarily the previous sets of financials. We simply go back to opening retained earnings on our opening balance and say, well, let's restate. Okay, but we leave the other sets of financials alone. And we say, okay, we're going to be transparent. We will put restated financials all over. I hope you do that. We'll put a note in explaining what the error was. Management takes full responsibility for this, and we move on. Okay, we've just been really transparent about it. The problem starts to happen from an ethical perspective when the client starts digging their heels in and starts saying, I don't want to change this. I don't want to admit it. Can't you disclose it as something, I don't want to put restated financials all over the place. I don't want this to happen. And you going, but you have to do it. And I've come across a couple of those situations as well. Well, that straight away starts to bring us to question the client's ethics. Because why don't they want to do this restatement? What is the implication? The banks are going to get up happy or this or that, or maybe it's going to be in Carmen's session where they're going to go, well, whoops, there's consequence here that is going to be expensive if I have to sort of show that, I misallocated those penalties into professional fees and I claimed them, or whatever it might be. And you're going like, well, you actually have to. So suddenly I've got a problem here because I can't maybe trust management's ethics or the way management does things. Now that means I've got to sit back and ask myself, can I keep them as a client? Now, auditors, that gives you another problem because you've got a clean audit report from the prior year. You said last year everything was fine, and it wasn't. Okay, especially if maybe that misstatement, which maybe you were unaware of, but through coming across things this year, you discovered this misstatement from last year because clients can hide things pretty well. And now there is a material misstatement in last year's financials, but the client is not changing them. Well, you've got a responsibility to inform the users that you're withdrawing your report, that they cannot rely on your audit report.
Yeah, and I think, Karen, this is also something which I think in this session we need to be very clear when we're talking about errors. Your considerations will change dependent on whether are you wearing the hat of the accountant preparing the financials? Are you wearing the hat of auditor? And are you wearing the hat of tax practitioner?
Yeah.
Because you're always looking at it from a slightly different perspective, and your rules that you have to apply are different. And I think that's something which isn't always as clear in terms of, well, there's a mistake, we can just fix it.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.